Money is important, and managing one's finances is a crucial skill everyone should know. But most people, when they hear about personal finance, they either feel bored or get overwhelmed. But what if I told you there is a simple, straightforward way to be in the top 1% of the population in terms of financial security? No need to get a degree in economics, no need to read tons of financial books, just 12 easy practical steps you can follow to build wealth and make informed decisions about your money. So let's get started. If you are new here, my name is Srijit, and on this channel, I aim to make money the least of your worries by breaking down complex financial topics into simple actionable steps. Now, I'm not a financial advisor. I'm just a guy on the internet sharing my experiences. So please do your own research before acting on anything I say here. I wasn't born into a rich family. So as I was a kid, we had our share of financial struggles, but we weren't poor either. After finishing my education, I found a well-paying job. I also started investing very early in life thanks to my mom. Over time, I saved enough to buy an apartment, stay debt-free, build multiple sources of income, and save enough, all by simply being mindful of how I spend and manage my money. I'm not sharing this to make anyone feel bad about the financial struggles. I just want you to believe that if I could do it, you can too. Because I'm not a financial genius or a guru, and there are no secret tricks in my approach. It's a simple plan, and it all starts by analyzing where we currently stand with our finances. Personal finance is after all personal, and each of us need an individual approach. So before we do anything, it's important to understand our current financial situation. And to start, there are two key things to focus on. Step 1 is to write down all your yearly income and expenses. This includes your salary, income from your side hustles, investments, or from any other sources. Then list your fixed expenses like rent, utilities, and groceries, followed by discretionary spending like entertainment and dining out. This is your cash flow. And in the second step, list your assets and liabilities. Assets are everything you own: your home, car, money in the bank, retirement accounts, investments. Everything goes in here. Liabilities or debts include all financial obligations you have, like student loans, mortgages, and unpaid bills. Finally, calculate your net worth by simply subtracting your total assets from your total liabilities. I know, this is not easy, so take your time, a week, 2 weeks, a month, but do this and note it down somewhere. This will come in handy later when we work through the remaining steps in this plan. You can use an Excel, Word document, or even a notebook and a pen. But the important thing is to do it, as understanding your cash flow and net worth is the key foundation for a solid financial plan. Now, take a moment to go through this data and assess your current financial situation. Am I spending more than I earn? Are high interest debts cutting into my income? Am I saving enough for my retirement? Remember, this is just your starting point. So don't be hard on yourself if the numbers aren't ideal. Most people have no idea where they stand financially. So the simple fact that you are even taking this step already puts you in a better place than most. As important as it is to know where we stand, it's also important to know what we want to achieve. So start by writing down a list of all your major financial milestones that you want to get to, both in the short term and in the long run. Short-term goals include things like paying off a credit card debt or saving for a vacation, whereas long-term goals might be buying a home, saving for a car, or building your retirement fund. When you write these goals, make sure that each one is smart. And by smart, I mean each goal has to be specific, measurable, achievable, relevant, and time-bound. For example, instead of saying getting rich soon, aim for something like I want to build a retirement fund of $500,000 in 20 years. You understand the difference, right? Now, rank these goals based on priority and urgency on a scale from 1 to 5. For example, if you have a credit card loan with a 20% interest rate, paying that off should be a top priority. Once the groundwork is complete, we can move to executing the plan. When it comes to managing finances, most people get it wrong at a very basic step: organization. Think of it like your wardrobe. You could throw all your clothes onto a single shelf, or you could also sort them into categories like winter wear, summer clothes, and home wear. Which approach do you think would be more efficient and make it easier to find what you need? The same logic applies to finances. Many people use a single salary account as the personal income, expense, and investment account all in one. And when the salary arrives, most of it goes towards bills and spending, and whatever is left over is considered savings. But you are here because you don't want to be like the other 99%. So if you want to get to that 1%, you need to have a different approach. And this involves being always mindful of how much money you earn, spend, and save. And the easiest way to do that is to have 3 separate bank accounts. An income account where your salary or any other income comes in, an expense account which should be used for all your spending, and then finally an investment account for all your savings. If you have a partner, then consider setting up a joint expense account for shared costs, along with individual accounts for income and investments. Then create standing orders to move money to your saving accounts first and then to the expense account every time you get paid. This is known as mental accounting, and it helps you to manage your finances more effectively. But then how much money should we move into these accounts? Time to talk budgeting. Not exactly a sexy topic, I agree. However, creating a budget happens to be the most basic step that will help you reach every other financial goal. We all have expenses in life, and we need money to take care of our needs and wants. By setting up a budget, we are not saying no to these expenses, but we are just saying yes to those that truly matter. And a simple way to start budgeting is with the 50-30-20 rule. Allocate 50% of your income to needs, like rent and groceries, 30% of to wants, like that new PS5, and the remaining 20% to savings. For those who want to take it a step further, you can break down your needs and wants into categories like housing, groceries, and transportation. Then set realistic spending limits for each category to get an even clear picture. But if you are just starting out, stick to the 50-30-20 rule. Build the habit first and then later expand. But I can guarantee you that no level of budgeting will be effective if you skip one essential habit: tracking your expenses. If you don't monitor your spending, you won't know if you are staying within your budget limits, and you won't be able to make any adjustments if needed. So track your expenses without fail. And there are hundreds of tools available, from free Excel sheets to paid subscription plans. I've created a template in Notion that I personally use for budgeting and expense tracking. If you're interested, you can download it from the link in the description below. But you don't have to make it that complicated. Just use a spreadsheet or as simple as a notebook. But note them down regularly, and then at the end of each month, see how you did. But even after you do all this, there is still one thing that can mess up even a well-planned budget. Debt is an important factor that often holds people back from achieving their financial goals. Whether it's your student loans, the mortgages, or the credit card balance, debt is a burden. Not just financially, but also psychologically. This is why it's so important to focus on reducing and managing debt, and there are 2 popular ways to deal with it. First one, avalanche method. Here, we target the high interest debts first, such as credit card debt, and then slowly work on others. This approach helps you save money on interest over time. Second one is a snowball method. It's just the opposite strategy, which is more about psychology than math. And here, we focus on paying off the smallest debt first. And this gives you an extra motivation boost when you see the number of debts coming down. Now, which method to follow depends on your personality and what motivates you. I would highly recommend the avalanche method because mathematically it saves you more money. But if having too many debts stresses you out, then do the snowball. When it comes to debt, it's also important to remember that not all debts are bad. Debt can be good if you are using the borrowed money to invest in assets that generate a return, like buying real estate as a rental property. On the other hand, it's always in your best interest to avoid debts like credit card balances, personal loans, or payment plans for consumer goods. But there is one major factor that pushes many people into debt and is often beyond our control. Emergencies. Life is unpredictable, just like the weather. You never know when an emergency, like a job loss or an accident, might come up. And having an emergency fund is like carrying an umbrella, just in case it rains. So, how much should you have in your emergency fund? You already know your monthly expenses from the first step. Now, aim to save at least 3 to 6 months worth of living expenses. If you are self-employed or the main provider for a household that includes your spouse, kids, and parents, then target up to a year's worth of expenses. But just start with what you can. Even if you're just adding $1 a day, it helps. And make sure the money is easily accessible but kept separate enough to avoid sudden impulsive withdrawals. You could consider options like a fixed deposit, or if you're comfortable with mutual funds, short-term debt funds can be a good choice as well. Personally, I've set aside 10,000 euros in a separate bank account that earns 3.4% interest, which I reinvest monthly into the S&P 500 ETF. This way, my emergency funds keeps me prepared while also helping to build my wealth. However, there are situations where even an emergency fund might not be enough. Many people see insurance as a waste of money. Lightning always seems to strike the neighbor, not us, right? But the truth is, our lives can change in an instant. And while we all hope for the best, it's smart to plan for the unknown. And that's where insurances come in. So let's start by talking about the most common one, life insurance. If you live in India, you probably have a relative who is a life insurance agent, and you might even have a policy from them simply because they force you to get one. You need life insurance coverage for only one reason: to protect your family's financial health in case of your untimely death. If no one depends on your income, there is no need to buy life insurance. But if there are others relying on you, then you should definitely consider getting one. And the most important question is, how much coverage do you actually need? And here is a simple, straightforward formula. Your coverage should be at least the sum of your current liabilities, the income replacement, and future expenses. The current liabilities include all your outstanding debts, which we identified in step 1. Income replacement is the amount needed to allow your family to maintain the current lifestyle in your absence. And future expenses are the funds for the future needs, like your child's education, buying a home, or marriage expenses. It's always better to be slightly overinsured than underinsured. And a good rule of thumb is to aim for a coverage that's around 10 to 15 times your annual income. And there is only one type of policy that offers this level of coverage at an affordable rate: term insurance. Now, term insurance is the purest form of life insurance, where you pay a company to insure your life over a specified period. You probably haven't heard of term insurance until now. That's because your relative insurance agent will never mention it. Instead, they are likely to push endowment plans or ULIPs, which combines investment with insurance. Why? Because on such plans, they can earn a commission as high as 35% of your premium. The day you realize the importance of separating your insurance from your investments is the day you take a big step toward building financial security. As I mentioned, life insurance is optional, but one type of insurance everyone should absolutely have is health insurance. You are far more likely to need hospital care for illness or accidents than to face an untimely death. And just like life insurance, the amount of coverage you need will depend on factors like your personal situation, your medical history, and where you live. If you think $1,000 of coverage is enough, then consider getting one for $2,000. And don't just go for the cheapest option. Always look at the insurance company's track record for settling claims. Choosing a good health insurance policy could be a topic for its own video, which I will make sometime soon. So be sure to subscribe to the channel and turn on notifications. Change can come in many forms, but a change that we can never avoid is aging. Aging brings its own set of challenges, not only mentally and physically, but also financially. Still, many of us spend little time planning or saving for it. We must ensure that we have enough to survive when the monthly revenue from a job stops. So as a first step, check if your employer offers a retirement savings plan, such as the 401k or a pension scheme. If they do, then sign up for it and make regular contributions. And many employers often match these contributions, essentially giving you free money, and you may also get some upfront tax benefits. However, this amount may not be sufficient to cover all expenses. And we can't rely solely on the government to meet all our needs in retirement. That's why it's essential to set up a personal retirement fund. And the sooner we start, the better, as it gives our money more time to grow and compound over the years. But then how much do we need to retire comfortably? It all depends on how much you spend and when you plan to retire. But most people, they would need around 70% of the take-home pay at the time of retirement to maintain the current lifestyle. Ideally, if you're starting young, then aim to save at least 1 times your salary by age 30, 3x by 40, 6x by 50, 8x by 60, and 10x by 70, provided you retire at 70 and go on to live until 100. If you already have other savings or assets, then you can adjust these numbers accordingly. The more you have saved, the less you will need to set aside each month. However, if you are just putting this retirement money into a regular savings account, or worse, keeping it under the mattress, then you are missing out on the eighth wonder of the world, compounding. The difference between those who build wealth and those who don't often comes down to this. Every day you are not investing your money, you are losing a part of it to inflation. And the good news is, you don't need a lot of money to start investing. What really matters is to start and to stay consistent, rather than waiting for that perfect moment when you have a large sum to invest. So do some research and open a brokerage account with an online broker in your area. If you don't have the time or interest to analyze different financial products, then consider starting with an index fund like the S&P 500 or the Nifty 50. This type of fund invests in top companies, giving you good diversification and steady returns. And the best way to invest is to do dollar cost averaging, which means investing a fixed amount regularly into an asset of your choice, no matter what the market is doing. And this approach helps smooth out the effects of market volatility over time and removes the emotional factor from investment decisions. But the most important thing is to start, and to start now. But where does the money to invest come from? In today's world, relying solely on one income source can be risky. A 9-to-5 salary is just one way to make money. But with the rise of digital economy, almost anyone can earn extra income from the comfort of their own home. I know, everyone is busy and it feels like there is no extra time left. But sometimes all it takes is a bit of time away from Netflix or Instagram to focus on learning useful skills and then using them to build additional income streams. For example, I work as a cybersecurity engineer during the day and also run this YouTube channel, which brings in a bit of extra money. It may not be much, but it's still something, and I'm building a valuable skill that gets better over time. But even if you don't have time to start a side hustle, at least spend 10 minutes daily to follow the next step. Knowledge is power, but sadly, personal finance isn't often taught in schools or at home. So it's up to us to take the initiative. And the more you learn, the better equipped you will be to make smart financial decisions. The fact that you are still watching this video shows that you are serious about this. So keep going. And other than videos on my channel, one of the best ways to learn about personal finance is by reading books. And if you're new to the topic, start with foundational books on budgeting, saving, and investing, especially from well-known authors in the field. The Psychology of Money, Rich Dad Poor Dad, I Will Teach You to Be Rich. There are so many good ones to pick from. There are also many excellent free resources available online to help build your financial knowledge. So make the most out of them. And finally, the most important step. Start, and start now without further delay. Why? Two main reasons. First, time is your greatest ally. The earlier you begin, the more time your money has to grow. And second, good financial habits take time to form. Starting sooner means these habits will become second nature faster. I know that simply watching the video isn't enough to change anyone's financial life. Information is only valuable if you apply it and make lasting changes to your habits. That's why I've created a practical guide with tasks and checklists to help you to execute the plan to take control of your financial future. You can download it for free from the link in the description below. I'm not promising these steps will make you rich overnight, but it will definitely give you a new structured approach to managing your money and help to reduce your daily dose of financial worries. I hope the video was useful and you got some value from this. I wish you all the best on your financial journey. Until I see you with another video, have a wonderful rest of the day and adios.